Welcome to the Maryland Mortgage Rate Weekly Mortgage Market Update for the week of July 15th, 2013. Hello, I'm John Thomas with Primary Residential Mortgage, here to give you your update. Well, last week finally was good news for mortgage rates. We did see mortgage rates move lower. If you remember, we were recommending floating to start the week because we thought the bond market would recover. If you look at the bond chart on the screen, big red candle, that was July 5th jobs report. Bond market just tanked, sold off, mortgage rates spiked higher. We recommended floating because we thought that was an oversell, and Monday confirmed that. You see the big green candle on Monday shows bonds moved up, nice recovery, and then the rest of the week continue to move up. You see the arrow there. The short-term trend is for mortgage bonds to move higher, which is for mortgage interest rates to move lower. So we are going to recommend floating your Maryland mortgage rate to start the week, hoping that mortgage bonds can continue this trend higher and we can see interest rates start to move lower. Now, if we look at what happened last week, we had the Federal Reserve Committee release their meeting minutes on Wednesday, and what that showed was half the federal members wanted to continue the bond buying program as is until the labor market recovered some more, and the other half of the Federal Committee wanted to actually start tapering the bond buying program now. So half and half. They were evened out, and then the Federal Reserve Chairman Ben Bernanke went on to soothe the markets after the report was released on Wednesday, saying that easy money policies will be around for foreseeable future. He was trying to give the market some stability because we need the housing market to continue, we need the labor market to continue. That's not going to happen if mortgage rates keep spiking higher. So his speech was to help the market stay calm, and that helped mortgage bonds move higher to end the week. We also saw unemployment per state released for May 2013 last week. If you look at the chart on the screen, you can see Delaware came in at 7.2% unemployment. Now, if we go back to the jobs report we saw on July 5th, it looked like a good jobs report. That's why the bonds sold off. But when we dig into it, it wasn't that great. That's why we were recommending floating. We thought it was an overreaction in the market. Most of the jobs created were low-paying jobs and or part-time jobs, so that's not good for the economy. And then if you dig deeper and look at the next generation of American workers, which is people aged 18 to 29, unemployment rate among that group is 16.1%. So those people are not getting jobs, they're not getting the skill set they need to move forward. So that's going to be a drag on the economy. In economic news, we saw the release of the Producer Price Index, which is a measure of wholesale inflation for June 2013. That came in higher than expected at 0.8% versus the expectation of 0.3%. Now, inflation is the enemy of bonds. The bond market did shrug that report off on Friday, so that was good news because most of that high was coming from higher energy costs, higher costs of gasoline, oil, that kind of stuff, which did spike up this past month. So that explains the higher PPI reading. But if that continues, that could be bad news for mortgage bonds, so we're going to look out for that. And then in the local news, the next free first-time homebuyer seminar in Towson, Maryland is Saturday, July 20th. That's from 10 a.m. to noon. That's at the Sheraton Baltimore North Hotel on Delaney Road. You can register for that event by giving us a call in the office at 410-319-3312. I'm sorry, that's 410-412-3319. 410-412-3319 or online, www.marylandhomebuyerseminars.com. Look forward to seeing you guys next week.